So our final session for today is one that aspiring investors and startups alike wouldn't want to miss, the Angel Investment Masterclass. And delivering this session is an industry trailblazer, Mr. Pushkar Singh, co-founder of Tremis Capital. He brings a wealth of experience and insights into angel investing, and we are excited to learn from him. Let's welcome him on the stage with a big round of applause. So please.
Hi guys, am I audible? Is it fine? You can hear me well? Perfect. So thanks for having me here. I know it's been a long day and all of you are tired, but so I won't try to make it a masterclass, maybe give you a conversation. It's not exactly a lecture or a workshop. I'll just share some of my learnings, what we have learned in investing, early stage investing with founders. What are some red flags you should look at? How should you think about investing? And I'll try to make it conversational, not boring. But before I start, I'm just wondering, how many over here are founders, like who are actual founders building companies? And how many of you guys have invested in companies before, the founders? Wow. And others, like how many of you have in general invested in startups or planning to invest in startups? Okay, awesome. So it's not a very complicated presentation, like it's a very simple thing, and maybe you can also ask questions. So we'll just start. I just want to talk about what are the key traits of fundable startups, and especially like if you want to become good at angel investing, you should also know how VCs think, because it's very critical to know like what goes into an investor mindset, how do they think, how do they act, how do they evaluate startups. Then we'll move to angel investing basics, what are the parameters you should look at while investing, and finally some red flags, common investing mistakes that a lot of founders, a lot of investors make. Any questions before we start? Anything you want me to cover for the session? Anything? Anyone? All right, so we'll just start. Now, when you start investing in any startup, there are different types. Sorry, I think this is better. So there'll be different types of investors. Now, when you're building any company, most likely, and if you're a first-time founder, you'll raise money from your friends and a family. We call it an F&F round. Why friends and a family? Because these guys have known you for a really long time. They trust you, and they also want you to succeed. For them, making money is not the only motivation. They also want to be a part of your dreams and help you achieve them. Then you have these angels, HNIs, rich people who invest in early stages. A lot of time they also invest in a pre-revenue startups. And once you grow a little bit, you have a revenue, you have launched your product, you start making some revenue, you get these VCs, what we call venture capital firms. Yeah, early stage VCs, late stage VCs. As the startup grows really big, you have these private equity players who invest hundreds of millions of dollars. For example, any company raising $200 or $100 million won't typically raise from a VC firm. They'll raise from a private equity firm. And then finally, it's an IPO. You do on a stock market and everyone makes money. Most of you guys would fit either in a friends and a family where you would like to invest money in someone you know, your idea, or maybe once you become more experienced with angel investing, you will become angels. Is that clear, or did I explain it well, or was that too complicated? All right. Now, we often get a lot of questions that from really smart founders that I'm building this amazing business and it's profitable, but VCs aren't interested in me. And why is that? Do VCs only want to invest in companies that are loss-making? Why do they want to back companies that burn a lot of capital? Now you have to realize that a VC, there are certain traits they look at in founders before investing. And for them, especially in early stages, profit's not very important. Eventually, the goal of every business is to make money, right? And eventually, you have to become profitable. But in the early stages, building a product, or there are other traits that VCs look at, which are more important than profit. For example, you can build a really amazing, nice, profitable business, maybe running a grocery store or a steel company, something, or a supermarket. But most likely, VCs won't be interested in such businesses. They want businesses that are scalable, innovative, and very high growth models. Now, the whole idea of raising external money, either from angels or VC firms, is to build a big company in a short time. You can always, for example, in India, we have companies like Reliance, right, or Adani, or these big conglomerates. They never raised a dime of private equity or venture capital, and they are like massive companies. But they took 3 generations to reach there. Now, the idea is if you want to build a Swiggy or a Zomato, you want to build something within 10 years, you need external capital. And you just can't build a conventional business like that. That the model you must be working should be innovative, scalable, and all VCs love growth. So it should be a very high growth model. And as a founder, whenever you're raising capital, this is something you must understand before you pitch your idea to any angel or any VC. That, hey, it makes sense to build a business that can grow quickly with capital. I'm not talking about burning capital and investing like $10 million to build $1 million revenue, but something which can, through capital, can grow quickly. Just an example, like in India, skincare is a really competitive category. But there's a company called Foxtail. They raised a large round in April or May this year. How they could do that? Because their growth was excellent. Now VCs love this growth, that how quickly you're growing. Because a startup is just a private company which is growing quickly. If you're not growing quickly, you're not a startup. Now, there are also a lot of traits that all VCs look at. For example, you must be hearing the word called disruption. Like everyone keeps talking about, it's a buzzword, that hey, we are working on disruptive models. What it means is you're building something which is changing the status quo. I'll give you an example. There's a company called Sky Air. Now, what they do is they do last mile delivery through drones. Now in India, of course, you have last mile delivery, Swiggy, Zomato, Blinkit, all these guys do LMD, right? Now they said, hey, people understand how LMD works, but maybe they can do it through drones. And these are the kind of ideas VCs like. Another one is, there's a company called Clean Electric. They also raised a lot of capital, and they are building fast charging for EVs. So EV charging has already been there, but they're saying, hey, can we charge our EVs quickly? So these are the kind of disruptions VCs love and they talk about. And this disruption keeps changing. So what was disruptive 5 years ago is not disruptive now. Whenever you build a startup and whenever you're raising capital, and also as an investor, whenever you look at startups, want to invest in companies, you always look at the future, not at present. So you look at models that can be disruptive in 5 years and that can grow really quickly. And of course, investing, venture capital investing is not a science. It's not like investing in stock market where there's a lot of data and you can go through numbers, balance sheets, P&Ls, annual reports. So, and it's, of course, there's a lot of gut feel. And how do you develop that gut is talking to hundreds of founders, reading a lot of reports, seeing what's happening, and also give you some insights towards the end that as an angel investor, how should you think? Like, the third trait all VCs look at is they want large markets. Like they don't want founders that are building something very niche. Why? Because you can build a fabulous, great business in niche markets. But as a VC, what we are interested in large businesses. Can this become a $1 billion business? And if the market size itself is 1,000 crores, you can't build a 10,000 crore business in that, right? So the market either needs to be large or it's a niche market, it should be growing quickly. That's what a lot of VCs, I would say all VCs look at. I'll give you a good example. Like you might have seen these rosemary oil essence on Amazon. Like now it was a non-existent category 5-6 years ago. Right now it's already a 500 crore category and it's growing quickly. Now I don't know why people are preferring, there's some documented evidence saying it stops hair fall or something. But these are the kind of niches VCs like that, hey, if it's not a large category, at least it's growing really quickly. Like for example, when Amazon came into the US, like no one was really ordering books online, but people were buying books online, right? People were buying books from offline stores and internet was growing quickly. So then Bezos said, hey, why don't I combine both? And I create a new category which will grow quickly on the back of the internet. Also, all VCs, whenever they invest in any startup, and as an angel investor also, you should keep this in mind is, you want to invest in a company that can eventually become a future leader. I don't mean number one, but at least a top 2 or a top 3 player in its industry. Then only you'll make a lot of money. There was a company called Hoko from Ahmedabad. They're a 3rd generation ice cream guys, like their family has been into ice cream business. They recently raised a large 100 crore round. Why? Because ice cream in India is a 3,000 crore category. And investors, because of their background, they know like, hey, these guys have the right skill to build a business like this. Now, as an angel investor, whenever you, and also talk about in detail, whenever you're investing in any company, everything is about founders. Like, are you backing the right founder? Because there's very little data. You just have to, and the idea is you find out the right founders who can build a large company. And we'll also talk a bit about how do you identify such founders, but most of it comes with an experience. As you talk to more and more founders, you look at their background, what they have achieved so far, what kind of vision do they have, and then you realize that, hey, these guys can build a large company. Finally, there is something called timing. For example, Zepto is a good example in India. Now, food delivery was there, e-commerce was there. They said, hey, why can't we combine both? Because people are already used to ordering food online, and they're already used to ordering groceries online through Big Basket or Amazon, but just that used to take maybe a day or 2 days. They said, hey, let's combine these two user behaviors. And these are the kind of insights as an investor you should be looking at. That, hey, is this founder doing something which is not creating a user behavior from scratch, but maybe combining existing trends and saying, hey, this is possible. People are already, for example, the example I gave of Sky Air. Now LMD already exists. People do it through bikes. They said, hey, why can't we do it with drones? Any questions, or was that too long? Usually I just get carried away because it's a very interesting slide, but would you like to ask anything or anything on this? Feel free to ask, guys. Otherwise it gets very boring for me. Mic for sir. Yeah, I can hear you.
You mentioned about Google. Could that be because it's the same family, which the Chola family, that sold Hackmore?
Right.
They sold in 2017, they had a non-compete. The founders were smart, they waited for the right opportunity for the non-compete to then start. Because it's a distribution model. Distribution is the key, so they had everything. So do you think if you have that kind of an unfair advantage, the VCs have to dislike you because of the fact that you have everything more or less in place?
Right, exactly. So in my opinion, and I'm not privy to the personal conversations, why these guys raised capital is because they understand ice cream business. Their family has been into ice cream for 3 generations. And before that, they were into distribution, like Prashant said. Now what they're doing is they are building a brand. They realize that, hey, we already sold a business and there was a non-compete, and now they want to build a brand. Now, of course, if I go to them and say, I want to build an ice cream brand, they're not going to give me like 100 crores. They might not even give me a crore. Why? Because I don't have the background. So whenever you invest in any startup, and I would say up till really late stage, a lot of things revolve around the founders. Are these the right founders? Can they build this business? Do they have the right background? What they have done so far? What is the eventual vision? Are these guys who are really passionate about building something? Are they solving a problem which is even worth solving? You'll find a lot of founders who are solving problems which are great problems, but maybe not a lot of people face them. So as an investor, then you have to use your judgment, your experience, whatever you have read, we have spoken, and know that, hey, this could be a big business. Yeah. I can hear you,
Yeah. So one of the things that you spoke about, and beautiful slide, first of all, thank you so much for articulating it so well. I think one of the things that you talked about was large markets, right? And with large markets comes the dinosaurs in that category, right? Like who have been there, if you take a paints, it's Asian Paints, right? So when a challenger brand comes with, let's say, one specific wedge that they will go to market and disrupt that category, what are some of the second order questions you would like to understand and get answers to before taking that bet on the new brand going after challenger?
Very interesting question. So the first thing I would like to know from any founder is, why do you want to sell paints? Like, what problem do you think people are solving? Like people are facing, and why do you want to solve this problem? Because we see a lot of founders saying, hey, this feels like a good business, or there's a big category, A lot of brands, this especially happens in consumer brands, where there's no moat. See, if you want to build an AI company, I can't build an AI company. I'm not an engineer, I'm an engineer, but I'm not an AI engineer. I don't know how to code. But building a consumer brand, there are no hurdles. Anyone can build a consumer brand. So whenever you're building a consumer brand, you need to go to any investor with a very compelling story. What I would like to know from you, let's say you want to launch a paint category. I would like to know from you, why paint? Which segments will you target? What problems do you think they are facing that Asian Paints or Dulux or all these guys are not able to solve? If you just say, hey, but it's a big market and it can have 500 people, or there are only 2 or 3 players, I'll say that's fine. But I'm not interested. I'm only interested in if you can eventually become a market leader. And that's a big if, because most startups fail. But at least in theory, you should be able to explain it well that, hey, this is possible. I think this is a big pain point customers are facing that legacy brands aren't able to solve. And hence, this is how I plan to solve it. And then I would look at your background, what you have done so far. Are you even a paints guy, branding guy? Are you a manufacturing guy? If you are, let's say, a computer engineer and saying, hey, I want to do a paints business, I'll say, yeah, that's fine, but then do it. And then show me some validation before I can invest. So, especially in India, which is a very crowded D2C market, there are, I don't know, thousands of consumer brands. If you're building a consumer brand as a first-time founder, you need to show solid validation, or at least some validation that, hey, maybe it's a new product, it's a massive product in Japan or somewhere, I'm bringing it to India, or I have a marketing experience, I have scaled consumer brands to a certain level, I'm the right guy to build the brand. It used to be quite easy 5-6 years ago, raising money for D2C brands, but now it's much more difficult because it's a very crowded category, even though it's a fast-growing category. Did I answer your question? Yeah, sure. So just a framework that as an angel investor, and again, you can have your own framework. Like, as I said, there's no rocket science. It's like early stage investing is more of an art. How a lot of investors evaluate startups is they use a framework called 5 T's. Now, why 5T? Because like in marketing, you have 5M or whatever like, so it's just easy to remember. The first T is team, which is founder, most important. Early stages, everything is around founder. Because founders build companies, not investors, not market, not employees. Founder and the founding team, the close team. So whenever you're evaluating any startup, you always look at, are these the right founders to build this business? There might be a founding team who are great to build a AI business, but they might not be great to build a fintech business, right? It depends upon their background, what they have done so far. So all investors, especially in early stages, they do multiple calls with founders. They spend a lot of time with founders. And even then you can't understand everything, right? Because a lot of things is about grit. Whether these founders will continue to build it for 10 years, 15 years. But as an investor, you should always look at that. Try to understand founders and see, hey, are these the right guys to build this business? And that comes with experience. Like no one can teach you that. You have to talk to multiple founders, do a lot of research, and then take a call. And most of the time these calls go wrong, because the majority startups fail. Still, you're always backing founders whom you think can build a big company. The second T is TAM, which is total addressable market, which is what we discussed earlier, market size. Is it a big market? If it's a niche market, is it growing quickly? Why? Because the aim of every VC investment or every startup investor is to invest in the next Zomato or next like whatever, Flipkart, or invest in a really large company. Now you can't build a large company in a tiny market. Either the market is growing quickly or it's a large enough market. Now most VCs don't think of competition as a deterrent, because any startup that comes into a maybe not a really niche sector, but most sectors will have some incumbents. As a founder, it's your job to disrupt them, to unseat them and build a new brand. So don't be scared if you're building something which is highly competitive. How as a founder you should look at is, do I want to build this? Don't do it for money, because if you want to be rich, there are easier ways to become rich. You can be a trader, you can work in finance, you can work in technology. Like you can go to a good MBA school, do consult, investment banking. Dozens of ways to become rich. You should only become a founder if you really want to solve a problem, you are passionate about it. And this is something that you would do without money. And then of course, You end up making a lot of money if you become successful. But for most successful founders, money is not the driving factor. For them, the driving factor is whether they want to do it and how committed they are. Do they want to do it for 2 years, 5 years, 10 years? And those, in my experience, those are the guys that eventually succeed. As an investor, you should always try to find such founders. There's also traction, not very relevant in very early stages, but there should be some revenue. A lot of investors look at, all right, what is the revenue growth? How quickly is the company growing? And traction doesn't only mean revenue. It could also be, for example, for an app. It could also be how many users do you have? What is your daily active user, monthly active user? There are different KPIs, metrics, a lot of investors look at. And every industry has different metrics. So whenever you want to invest in certain industry, try to read a bit about that industry. What metrics do these are specific to this industry? How should I evaluate startups? Fourth is technology. Very important. Not, I would say, not very important maybe for D2C brands because these are non-tech businesses, but for everything else, all software, AI, hardware, everything, what kind of technology you're building, is team the right team to build this technology? And finally, timing. Is this the right time to build this business? Like the example I just took on the last slide. Now, maybe 10 years ago, Zepto wasn't a great business to build because the infra wasn't there, people were not used to ordering online food, there was no e-commerce, the behavior wasn't set. But it could only come 2 years ago because at that time, the consumer behavior was there and the right technology was there. For example, in US, in 99, 2000, there was a company called pets.com. They used to sell pets food. Now they raised a lot of capital and still failed. Why? Because the supporting infra wasn't there. It wasn't possible to collect money online seamlessly or do logistics. They had to do their own warehousing. The infrastructure wasn't there, and hence they could never scale. They could never become profitable. But now all the supporting infra is there, and you can really, and whenever you're building, you shouldn't, like people say, maybe he was too ahead of its time or too behind your time. Your timing should be accurate. Then only you'll be able to build a large business. Any question? Anything someone wants? No. I'm just saying, anyone? Okay, so this is just a scorecard we used to use when we started our fund. Very simple scorecard. You can have your own version. It just says for me that, hey, these are 5-6 parameters I want to evaluate all early stage companies in. And all these weights are also subjective. As an investor, you can say, hey, I want to give more weight to team. I want to give less weight to whatever technology or landscape, timing, whatever. And then, so if you want to become an angel investor, I would recommend it's a good idea to evaluate maybe 5-10 startups on these parameters. And then you can have a threshold saying, hey, if the score is above 8, I'll invest, or at least I'll consider it seriously. Now, again, early stage investing, as I said, is not science. Like there's not enough number. Most of it is very subjective. So I don't know, like you can say this team is 9 or this team is 7, this team is 8. There's no way to quantify it, right? This will come with experience. Once you have spoken to dozens of founders, you know, hey, how does a good founder look like? How do they talk like? You must have listened to some interviews, some podcasts. So whenever you start investing, before that, I would recommend spend some time reading about it. Spend some time doing research. Just don't go out and invest like the first startup you come across. And you can have your own parameters. This is just an example that we use. And once you have invested in 10, 15, 20 companies, then you don't really need this framework because by that time you have become more experienced. But when you're starting out, and as a founder also, whenever you're raising money, you should focus on these parameters. You know, like, hey, VCs are going to evaluate me on these 5-6 parameters. How can I polish my storyline around that? How can I be a good storyteller? How can I cover all these bases? And this, again, is not a very exhaustive list. There's something we use, or we have used in the past. Any questions? Is it really boring? Yeah, sir, please.
So, Pushkar, do you have cases where people come to you and tell you that I did speak to a bunch of VCs, and some of them say that this model has not been tried and tested in this market. It's not a lift and shift from the US or somewhere. I mean, what do you tell a founder in that situation?
All the time. And especially if you're building something very futuristic, you'll get this comment from a lot of investors. Now, I would say there are two things how you, as a founder, how you can raise money. One is you must be able to convince the investor that you are the right person to build it. Like, do you have the right background? Now, if I go to someone and say, hey, I want to build a metaverse, and I worked in finance all my life, no matter how good storyteller I am, how compelling my storytelling skills is, no one is going to take me seriously. So first of all, I should also have the right skill to build it, right background. And then second, all investors would like to see some proof of concept. Especially as a first-time founder, if you just go with a fancy idea, it's very difficult to raise capital in India. And as an angel investor also, see, because ideas are cheap, like anyone can have an idea, and ideas inherently don't have much value. Try selling an idea to someone. There's no market for idea. Because eventually what matters is whether these people can build on this idea, right? And so whenever, if you're a first-time founder trying to build something very futuristic, my advice is do it on the side on a full-time job for 6 months, a year. See, can you build something? And then go to investor and say, hey guys, I have worked for a few months on this. And now I want to raise capital. I already have some skin in the game. It's just not that, because we, like Sandeep asked, we get it all the time that some founders saying, hey, we have this great idea, all VCs have said is very futuristic, we can't invest. But if you give us 2 million, we can, we'll just quit our full-time job and then build on it. I tell them, why don't you build it on the side? You don't need venture capital to, see, if you're not a coder, you can't build a coding company. And if you're a coder, you can work on the weekends. Do that, do it for 6 months, and then we'll see. Are you really passionate about it? So we'll talk about founder traits, like what are 4 or 5 traits we'll look at in the founder. But I'll just tell you, so as an investor, number 1 is, are these guys have the right expertise? Like, what have they done so far? If they're building a tech company, are they coders, are they engineers? Have they worked in technology companies before? Second, how passionate they are about that idea. Now, of course, passion is very difficult to judge passion, right? You can still judge expertise, but very difficult to judge passion because every founder says, I'm very passionate. So I want to know, will you do it without money? Let's say there was no money into it. Are you in it for the money, or do you really want to solve this problem? Now at a very early stage where there's no product, I always advise a founder that, hey, work on the sideline. You don't have to quit your job. Do it on the side. Work it for 6 months. Show us an MVP or other investors, not only us. And then if you have done that kind of work, that means the founders are passionate. Also, one trait that all VCs look at is grit or persistence. Because see, in a startup, you'll always have ups and a down. And at that stage, an angel investor or a VC can't help you. As a founder, you're always fighting against the odds. Most startups fail. So as an investor, how do I judge grit? There's no way to judge it. There's no metric or there's no scorecard, there's no report I can use it. What I try to do is, and all investors like to do it, they use their subjective judgment. Because they have spoken to so many founders, they try to speak them multiple times. See, hey, do these guys want to build it for 10 years, 5 years? What kind of vision do they have? How big it could be? And then you take a call.
Hi. Hello.
Not very important, very early stage. So you would always look at unit economics, that what are the gross margins or net margin at that level, but something like your GTM strategy or your capital efficiency. So capital efficiency is basically, let's say there are 2 startups. Both are at a certain stage, similar, all things being equal, same kind of product. One has reached $1 million revenue using $5 million of capital. The other guy has reached the same stage using $10 million of capital. Now the person who used $5 million is more efficient. That shows that he can, with lower money, he can take the startup to a larger level. Now this is a metric a lot of investors use, I would say series A and beyond. But in very early stages when there's hardly any revenue or you have just raised $1 crore, 2 crore, it's not a very relevant metric. But people would still like to know that what are your unit economics, what are your gross margin, what are your net margin, what is your GTM plan. And maybe at an idea stage, that's not really relevant.
Hi. So I have 2 questions here. So first is how generic is this metrics that you created in the
Sorry,
market?
how?
How generic? And second question is, what was your rationale behind coming up with these weights, grades, and weighted scores?
So most VCs would have some kind of metric. Either they do it on a paper or they do it in their head. But they have these 5-6 parameters that they evaluate founders on. And like I said, so I would say not exactly this one, but similar kind of metric, a lot of investors use it in some form, similar kind of scorecard. Number two, how did we come at weight? Because again, it's a very subjective call. For some investors, they'll say, hey, for us, founders is everything. They don't really care about competition or how efficient the capital is. For us, if they're good founders, we'll back them.
So do they do actually the market research kind of thing? Like look at the founder companies and see how many companies are succeeded because of good team or good TAM, like or like that, or it's like a intuitive understanding of like I'll go with a best team which has best idea or something like that.
So all investors would have a research team. They do a lot of market research. They speak to a lot of founders, and they also look at your team, your background, what you have done so far. They speak multiple times with you. See, you might think that investor is wasting my time, why they're talking so much to me. But the point is, at an early stage, all ideas sound promising. There's no way to say this founder is really good, this founder is not so good, unless you haven't spent a lot of time with them. And as an angel investor, even when you want to write smaller checks, this is something you must do. You should spend a lot of time with the founders. And if the founders aren't fine with it, they say, hey, I don't want to spend 10 hours with you. Then maybe he's not the right founder, she's not the right founder for you. Because there are no numbers, right? When you want to go on the stock market and buy some company, you have annual reports, you have a lot of P&L, balance sheet. In early stage, a lot of it is about gut. That, hey, do I understand this technology? Do I think this technology will become better? And how do you assess founder? By talking to them, by seeing their background, understanding their vision, what they have done so far, talk to their maybe former employees, do your research, what kind of companies have they worked for.
Okay.
Did I answer your question?
Yeah, so one more question. So how you came up with this scorecard? Like, is it by years of experience you came up with? Or when you started your scorecard, was that like team was first or time was first, like that? Or
So see, for any investor, team is always first, early stage. Team is always most important. You can argue about the weight, like why 30%, why not 50%, or why not 60%. This is something we usually invest in the companies that are more like a seed Series A stage. And we think this kind of works. Again, this is not very scientific. What I'm telling you is you should understand investors' mindset. And as an angel investor, you should understand VC's mindset. That, hey, how investors think like. Now, some investor will say, hey, for me, like capital efficiency, it's not relevant. I don't care for that. What I want is a really strong team and a really strong technology. And that might also happen.
so how successful was your investment with these metrics?
See, again, when you're investing in startup, it's a very long-term game. So you don't see your success in 2 or 3 or 4 years. We have been somewhat successful. I don't say very successful. But again, success or failure, a lot of it also about luck. What you can do as a founder, as an investor, is follow a method. Follow a checklist that you think is correct. And then, of course, not every investor makes 100x. A lot of it is whether you found the right founder, right company, right stage. But if you follow a checklist or if you follow a method, you improve your odds. And see, the whole purpose of this conversation is I just want to give you some idea that how should you think like an investor. Now, I'm not saying you'll become Warren Buffett or you make like 100x. No, I can't teach that. But what I can tell you is, hey, this is how you should think like.
Got it. Thanks.
What is your IT portfolio?
Honestly, I don't remember. So there have been quite a few companies like we said no. And then they went on to become big companies. But I don't want to talk about it. Okay. Yeah, but I think we have missed out on investing in great founders. A lot of time. Why? Because we were not smart enough. We were also starting out. We didn't see these founders can become really big, create great companies. And all investors, angel investors, VCs, private equity funds will have a lot of these misses. But see, as you of course know, in hindsight, the vision is always 2020, right? So looking back at things, you always know, oh, I should have done that. But at that point of time, you take a subjective call.
Hey Pushkar, just one question, curious from one of the topics that you touched upon while you were speaking. You mentioned that a lot of angel investors have come to you that they'll quit their job after they get their funding? What percentage?
Not angel investor, founders.
Yeah, founders coming for angel investment would suggest that they'll quit their job if they get the funding. What percentage of people come and do that?
Very difficult to quantify, but I would say maybe 1 in 5.
Okay, that still happens then.
Yeah. Still happens.
Thanks.
See, because if you go to someone and say, hey, give me money, and then I'll do this, that means the person is most likely not interested. Because if you're really interested, you would do it on the side. You would do as a hobby. You won't wait for someone to give you money. And a lot of these great companies, they started out as projects, as hobbies on the side. So, and one thing I always tell to all founders and all investors, everyone is, fundraising is not the goal. The goal is to build a big company. Never lose sight of that goal that, hey, I want to build a big company. Fundraising, venture capital is just one way to build that company. You can also bootstrap and build a large company, or different ways to build it. But don't say my goal is to raise 10 million or my goal is to make $100 billion company or whatever. Say what you should be thinking about is, hey, I want to build this big company. Why? Because this is a big problem to solve. I think a lot of people are facing this problem. I am the right person to solve it, and I'm also passionate about it, and most likely I have the right skills. I also think the skill part is a bit overrated, especially because if you're young in India, you can acquire all these skills. If you're 22, 23, 25, you don't need to be a top coder to build a coding startup, but then you need to work hard. You need to spend 2-3 years learning coding, and then you can build a large startup. So don't let skills be a deterrent. But you must be really passionate about it. You must say like, hey, I want to solve it because I think this is a big problem. And this is what all investors also look at. Or at least try to assess that. I know it sounds very random, like you can't really put a number to it, but this is what we do in our head all the time. Have some of you heard about power law, 80-20 rule? It's a very simple way to understand startup investing. Not very relevant from a founder's perspective, very relevant from an investor's perspective. So when you start investing in startup, always try to make a portfolio. Why? Because in startups, most bets fail. No matter how smart investor you are the best investor in the history, still you would have much more losses than wins. But why invest in startups? Especially when you invest in early stages, because the companies where you invest and have done well give you 50x return or 100x return. Hence, you should always look at a portfolio level. Let's say you want to start your angel investing journey. Then how you should look at it is you say, I want to invest in 20 companies over next 2 years or next 3 years. I'll also talk about how much money should you invest or how should you think about it. But always look at a portfolio level, not an individual level. But before evaluating any startup or before investing in any startup, you should, at least in theory, there should be a chance that this can become a 50x bet or a 25x bet. You don't invest in companies where the upside potential itself is only 2x or 3x. Why? Because let's say you invest in 20 companies. Now 15 of them failed. Now at a portfolio level, you must make your entire return from those 5 companies, right? Or 3 companies, whatever became hit. Now if these companies only gave you a 2x return at a portfolio level, you lost money. You're not a smart angel investor because you didn't make any money. You actually lost money. Hence, all VCs and all seasoned angel investors look at companies which in theory can give you a 25x return, 30x return, 50x return. How do you identify such companies? You look at scalable business models. Because as an angel investor, your money will come from valuation. Your stake is always linked to valuation. Valuation is linked to revenue and growth. So if you invest in businesses that can, in theory, grow at 20x, 30x in 5 years, you will make money. Eventually, you will make money if you invest in a lot of startups. But if the upside itself is capped at 2x in 5 years, even if the company does well, even if it doesn't fail, you won't make money at a portfolio level. And this is something as an angel investor you should always look at. You should always diversify your bet. Never invest all your capital in 2 or 3 startups. Try to create a portfolio of 20 startups, 25 startups over 2-3 years. We'll also talk a bit about diversification, how should you diversify. But any questions on this from the VC's mindset?
Hi. First of all, it was a wonderful session. My question is, previously you have shown us a scorecard about investors' perspective about the founding companies, right, in startups. So do you have a similar scorecard for valuation, like how a company is being valued for whatever amount?
Actually, I have, but I didn't put in the slide. But
Okay.
I'll tell you how valuation is done in India, all over the world,
Yeah.
in early stages. When you're investing at a pre-revenue stage or a pre-product stage, everything is about negotiation. Founder might say, I want a 50 crore valuation. As an investor, you will say, but I'm fine only giving 25 crore. If both of you like each other, you try to arrive at a middle ground. Because there is no revenue, there is no validation. Right now in India, and I'm talking also about the first time founders. Now if maybe Bhavish Agarwal starts a new company, he'll get $1 billion valuation. Because he's a famous guy, right? But as a first time founder, when you're starting out, most investors at a very early stage, when you're building the product, pre-revenue stage, you will get maybe like a 15 to 25 crore valuation, something like that. If you have some revenue, you already have built the product, the valuation would be between 25 to 50 crores. What we call a seed stage valuation in this country. And then once you start making revenue, there's a metric called ARR, annual revenue run rate. You multiply your monthly revenue times 12 and you get a multiple on that. Let's say your monthly revenue is 1 crore. Your annual revenue becomes 12 crores. And you're building a SaaS company. This multiple in the market, and this multiple keeps changing. This multiple, let's say in the market right now is 8x. So you'll get 12 times 8. You'll get 96 crore valuation. This is how valuation is done. And again, it's not a very hard science because this multiple also depends upon a lot of things. What is your gross margin? What is your net margin? How quickly have you grown? How efficiently have you been able to use capital? But there is a range of multiple for companies, I would say more than 1 crore monthly revenue that all investors use. All deals fall in ballpark in that range. So if the D2C multiple, right, let's say is between 2 to 4x, it's unlikely that you'll get a 8x multiple. Now, you might get 2, you might get 2.5, you might get 3, depending upon your product growth, gross margin. But you can't say, no, but I'm building this amazing product and I want a 20x multiple. That won't happen.
Thank you. Thank you for the answer.
Yeah.
So I just looked at Tremis' website and one of the interesting thing that it talks about is you always co-invest with a lead VC, right? So from a very VC modus operandi perspective, considering you invest in pre-series A, how do you look at like having a lead? Because in seed, typically you're trying to figure the round out.
Right.
And you will enter typically, like I'm asking more from a VC angle, less from a founder angle, which is you will actually enter the deal very late and you might not get that deal. So from a opportunity perspective, like why that criteria and how it helps you make better decisions?
Right. So I'll also answer from an angel investing point of view. So whenever you start investing in startups, now there are two ways to invest. Either you say this founder is using 1 crore in very early stage, I'll just put in the entire crore, I'll put in 50 lakhs. Or you'll say, I'll wait for experienced investors to give them a valuation and then I'll invest a smaller amount. Now all first time founders who, I would say 99% first time founders who raise capital in this country, anything above $1 million, I would say $1.5 million, there are multiple investors. They're a group of investors. There'll be a lead investor who's most likely a large venture or maybe like a medium-sized venture capital fund. They would put in $500,000, $1 million, depending upon how much the founder is raising. So if the founder says, hey, for example, you go to investor and say, hey, I want to raise $2 million. Now what the lead VC will say is, let's agree on this valuation. I give you $1 million check. Now go out in the market, talk to smaller investors. He'll also introduce you to other smaller investors who can put in 100K, 200K, 300K check. And then you collect around. Most angel investors, unless they're investing in a friends and a family round, where they're just supporting their family friend, they like to co-invest with maybe an accelerator, or they go through some syndicate. I'll also talk about what syndicates are. But this is the general modus operandi. And this is how we look at why we co-invest. Because the stage we like to come in, where there's some revenue, some validation, we don't have enough capital to be the lead. So ideally, if I really like a company, I would like to put in $1 million check. If it's raising, let's say it's raising a 2 million. But my fund or my syndicate, I can only put in 200K. So what I'll say is, hey, I like you, but I can't be the lead. I can't set up the valuation terms. You find a bigger investor, they give you a term sheet, they give you a valuation. And then if we like you, we'll join those round at those terms. This is how angel investing also works. Most likely you're not going to decide on valuation or you're not going to dictate valuation until unless you are the main investor. The main investor dictates valuation terms and then you just join on those terms. Join the round.
So my question is, what are the difference between seed investment and angel investments?
To be honest, all these jargons are very confusing because a lot of time you'll see, hey, I'm raising a pre-seed round of 5 million and there'll be some guy who raised a series A round of 2 million. Technically, a pre-seed round means you haven't built the product or there's no revenue in a very early stage. And angel investment usually happens at a pre-seed round or a seed round. Seed round is when you have built a product, there is some revenue, you already have launched a minimum viable product, there is some product in the market, some revenue, but it's too small for a large investor to come in. For example, friends and a family round, you can think of it as an angel investor. And all these angels, especially the bigger angels, whenever the startup raises their Series A, Series B round, they co-invest. To come back to your question, the difference, so seed or pre-seed, there are stages. Seed, pre-seed, Series A, Series B, Series C. There are stages of startups. In pre-seed and seed, angel investors dominate. Series A beyond, VC funds dominate. And as an angel investor, you're only investing a smaller amount if you are. Most angel investors invest in seed rounds. Did I answer your question? Did I explain it well? Just to come back to what I talked about, 80-20 rule, and why do VCs invest in multiple startups? Because venture capital industry, like it's about getting that 25x return or a 50x return, what we call a home run in baseball. So you don't want to invest in a company where you only get 2x or 3x return, even if the company does well. Now, 2x, 3x is not bad. It's a great return. But if you invest in 20 companies, then you realize that if 15 fail, and the remaining 5, even if I get 3x, I'm not making any money. I'm losing money at the fund level. This is how all funds look at. So they're always investing in companies that are highly scalable, investing in startups that in theory can give them a 25x return or a 50x return. As an angel investor, you should also follow that playbook. Don't invest in companies where a founder says, hey, I'll just give you 15% return every year or a 30% return every year. Because if you want to invest in that business, only invest in such companies. Don't mix and match. Because see, when you're investing in a startup, you don't know this startup will give me 25x or this will give me 0. If you had that vision, then you'll be a billionaire. Like all your bets will give you 50x return. What you're doing is you're taking a call, your calculated bet and saying, hey, there's a chance that this startup can give me 25x return. Now, if I'm investing in 20 startups, I want all those startups to, at least in theory, give me that kind of return. Right? Then only at a portfolio level, I'll make money. Too difficult to understand? Any question or did I not explain it well?
So 3 years down the line, how do you know that which one, say for example, 20 companies, out of those 20 companies, 5 is going to be successful, rest 15 is going to fail probably. How do you know that in the short run, that's going to be the case? Because say for example, in the case of Slack, it took them 3 to 4 years to get into product market fit. But if you evaluate Slack in the first 3 years, it was a video game company or something like that, and that's not going to make a good result, right?
No, very good point.
Yeah.
So see, usually, again, venture capital is a long-term investment game. You don't invest in a company to make money in 2 years or 3 years. Now, let's say you invested in 20 companies. over, let's say, 2-year period. As an angel investor, you said, hey, I want to invest in 20 companies. In 2 years, you invested in 20 companies. Most likely over next 2 additional years, 10 of them would fail. They might not be able to raise new capital, and then they would fail, they'll shut down, founders will do something else, they'll go back to their jobs. So in startups, the failure happens relatively quickly. Yeah. And the remaining 10 also won't succeed. Out of those 10, maybe 5 will raise their Series A rounds, and they'll fail after that. But the guys who raise their Series B or Series C, at that level, the failure rates come down. But if you invest in a Series C startup, you won't make that 50x return because the valuations are already very high. So it also depends upon the fund mandate. There are funds who invest in Series C, Series D startups, also private equity funds. At that level, the chances of failure are low. But then you also don't make that 50x return that angel investors make. So that is how they balance their portfolio. They say we are fine with a 3x return, but all our bets will succeed, or maybe 70% bets will succeed. As an angel investor, you will say, I'm chasing that 25x or 50x return, but I know only 10% of my bets will make money.
See, as an angel, when you're putting in money, it depends on the stage you're putting in money as well. So if you're putting in money at pre-seed, you are expecting some success to happen in a 5 to 7 year cycle. So you're taking a 5 to 7 year pre-cycle bet. At seed, it's probably a 3-4 year cycle. So a pre-seed company could fail in the first 2 years, but a seed company could probably fail in the next 3-4 years. So you're kind of preempting some of that cycles. But the gestation period for a company to work out is optimally between 5 to 8 years. Is that fair?
Yeah, very fair point. So as an angel investor, once you start investing in a startup, you should have at least a 5-year horizon. Don't go with a 2 or 3 year horizon, because this is again illiquid capital. Even if the company is doing well, you can't sell those shares. And we'll also talk about, as an investor, how should you allocate capital? How much money should go into startups? What are the risks involved in investing in startup? But always realize that most startups fail. Why? Because by nature, these are risky businesses. You're not starting something which has a very high chance of success, because then the upside would be capped, right? One of the core rules of finance, and I won't say rule, but an observation, is risk is always related to return. The opportunities you invest that are high risk also carry a high return in theory, right? So early stage venture capital, like these are the kind of bets to invest in. You know, like there's a big chance the company will fail, but in case it succeeds, I'll make a 50x return. I need only one such bet to make money at my portfolio level.
All right, I got one more question regarding the friends and family round. If the cap table is so mixed across the friends, how lucrative it will be for the angel to come and invest? Or do you really look on the cap table of having multiple friends on the?
Very good question. And I'll tell you, there's a lot of concern around that. I have 20 angels on my cap table. Will that crowd my cap table? Don't be unduly worried about that. How, as I would say all early stage investors look at, is if you're confident enough to go to your friends and family and raise a capital, that's a big validation. Because those are the people you have known for a long time. And them backing you also means they see something in you. So as an investor also, I get validation. Like if you approach us, let's say professional angel investor, and assuming you have worked for a few years, you have a network, you have colleagues, they would always ask, like, why aren't you raising from your network? Why don't you just raise a small round from your network? You don't have to raise $1 million. But why can't you raise a small round from your network and then come to us? Build something, have some validation, some customer, some revenue, and then you come to us. Because to me, that shows a big validation that as a founder, you aren't scared to go to your friends, your family, your ex-colleagues and say, hey, I'm building this, put in some money. To answer your question, like, to me, it's a big validation. Like if some founder has raised a friends and a family round, I also understand that if you're a very young founder, fresh out of college, might not be possible for you because you don't have the network. But for someone who has worked for 5, 6 years, 7 years, already had like some network, good idea to raise from your network. A small round need not be a large round.
Thanks for that. Yeah, I was thinking the other way around, because if the cap table is all mixed up, I thought no one is going to invest, but you
See,
put the right.
Yeah, you're right, but there are ways to turn it around. So don't be unduly worried about those things that my cap table is crowded. No VCs really say, hey, your cap table is crowded, I'm not going to invest in you. They'll tell you, we'll figure out a way. Don't worry. I like you. I like what you're building. I think this is a good company. Now, let's talk.
Thanks.
Hello, hi. When you say VCs invest in multiple startups, is it also common practice for VCs to go sector agnostic? And
We'll talk about it, but
Yeah.
usually there are two kinds of funds.
Right.
One are sector-specific funds.
Yes.
For example, there are a lot of D2C funds in India.
Okay.
There are a lot of deep tech funds. There are a lot of SaaS funds. Usually, smaller VCs are sector-specific. Why? Because they can't have a large team, right?
Right.
You have a small fund, you have a small team. You can't become experts in all sectors.
Got it. And the multiple expectations, they're different across sectors, right? I mean, fintech, agri-tech.
Yeah.
Is it?
It varies. It varies a lot. So SaaS multiple could be 8x or 9x.
Okay.
Whereas in D2C, it could be as low as 2x, 2.5x.
Got it. Yeah. Thanks.
And see, these multiples also keep changing. Way back in 2020, 2021, when venture capital was easy, like you had companies like Cred raising capital at, I don't know what, 100x multiple, 80x multiple. Now that won't happen in today's market. But tomorrow or next year, next to next year, if whatever global macro situation again improves, you will see multiples going high. So right now we have seen a multiple compression, but then again they can expand. It's very similar to if you guys invest in stock market, there is something called price by earning. Like every share, let's say a company is earning $1, you say, all right, the share value is 20 rupees. So it's 20x. So you should think of similar, like because startups are no earning, you use revenue as a substitute for earning.
Yeah, just adding to the risk reward concept, we can probably state it like for a high risk investment like VC or angel investing, there is a possibility of a high return, but a low probability of a high return. From the diagram that you have shown, the possibility is there, but the probability is quite low. The probability of low return is actually high, which is what you are showing on the graph. Yeah.
Sir, from a single investment, the probability of making a high return is extremely low. Right. Yeah. So if you only invest in one startup, there is a 95% chance you lose money.
Right.
Hence, all VCs diversify.
Yeah.
And even when they diversify, not all VCs make money. A lot of VCs even fail to return capital to their investors because they also raise money from different investors, right?
That's right. Yeah.
And as an angel investor, we'll talk about how much capital to put in, but always try to diversify. And I'm not saying spray and pray. Don't say I'll invest in 500 companies. But think about investing in at least maybe 20, 25 companies. Most likely you will make money. But of course, it's not a 100% guarantee. It's not FD or it's not real estate that you will make money. Yeah. Hence, it's a good idea to invest maybe 5% or 10% of your liquid capital into startups, private equity.
Right. Typically, what for an angel investor, what is the return that in India they target? Let us say a risk-free return of 6.5. How many times of that would typically?
Very good question. So again, there is no hard rule. You should have your own rule. How I would look at it is, stock market gives you 15%. Startups are liquid investments. You can't sell them when you want. It should be higher than 15%. If you're investing in very early stages, it should be at least 25%. 25, 26% means over a 3-year period, your money doubles. So let's say you over 1 year, you invest in 20 companies, and you get a return after 6 years, it should be at least 4x so that you made a 25% return. Because had you invested in, you would see, again, in a country like India, it's very easy to get 15% return from stock market, right? The only reason you're investing in a liquid asset is for the alpha. You want slightly higher return. Now, some VCs do get 30%, some get 22%, some get 17%. A lot of them can't even beat the stock market. But the goal should be beating the stock market and having a premium on that.
Right, yeah, thank you.
So most VCs are under moonshot business. Okay. So if I may just
Yeah, sir, please.
So if I might just take this question. So if you look at capital coming into private equity and venture capital from pension funds, endowments, they have their normal spreads, which is fixed income, equity, etc. So the bottom 5%, 3% gets allocated to VC and PE. So there, they basically essentially put money into funds or fund of funds for outsized return. So VC would probably do 20 deals, 30 deals, but the 3 deals that hit the ball out of the park, like you said, is what makes the fund. So you don't want to bet on average horses, you want to bet on the coals, the guys who can outrun everybody else. So they're not in the business of ensuring that, oh, 10 of my companies did 3x, 5x. I really want 2 of those companies which will end up like a Slack, for instance, if they're lucky.
And as we discussed, not all VCs make money. A lot of VCs lose money. A lot of angel investors also lose money. So Kaufman Foundation, they're a large US investor who have invested in hundreds of VC funds. I think this is 2013 study where they studied 86 VC investments because they invest in funds. They don't invest in startups. And then they get their money back after 10 years. And the study they did, they realized that after 27 months, only 43% funds were profitable, whereas 57% funds were losing money. But then it flipped towards the end. Out of these 43% funds, 37 funds, towards at the end of the fund life cycle, and typical of fund life cycle is 10 years. 24 funds actually made money. They gave them a positive return, whereas 13 lost money. Whereas the 49 funds that were losing money after 27 months, on paper, 25 of them flipped around. They made their money. Why did it happen was, see, if you're a fund or if you're an angel investor, you invest in 20 companies. Now in 2-3 years, the ones that the ones that will fail have already failed. But the ones that will do well, their valuation hasn't risen a lot. So on paper, you're giving them a negative return. But after 5 years, after 6 years, after 7 years, the companies that survived the first 2 years, first 3 years became valuable. And then your money comes in. So a lot of funds or a lot of investors, they'll say, hey, I invested $1 crore across 20 startups in the first year. After 2-3 years, you realize, hey, my portfolio is down because 15 or 10 of them have failed. So that 50 lakhs have become zero. The remaining 50 lakh is still worth 50 lakh or 75 lakh because the valuation doesn't really rise in 3 years. It takes maybe 5-6 years. But the companies that survive that 3 year, some of them go on to become valuable companies, and then you make money on that. Hence, the golden rule of angel investing is have a longer term vision. Don't invest for 3 years or 4 years. Like at least invest, I advise people to invest at least for 5-6 years.
What's your exit strategy?
We'll talk about like how do angels make money.
Yes, and I would like to know that how do you get it? Like how do you impact?
There's a slide on it. Just one thing, sorry, how much time do we have? We have like 10 minutes. So there's a lot of content. I'll quickly try to go through it. So this is something we already discussed. Why do angels invest in startups? One is to make money, but also you want to support your friends and family. That's not the only reason to investing in startup. Some people invest because they want to stay active, learn about new technologies. They want to diversify their portfolio. Some of them are these big entrepreneurs like who have made a lot of money from startup. They want to give it back to the ecosystem. There are different motivations for investing in startup from an angel investing point of view. For VCs, it's about making money. But if you're an individual, you have different reasons to invest in startup. Making money is one of them. Now, what are the pros and cons of investing in early stage if you want to become an angel investor? These are some things you must be aware about. And I'll talk about the advantages. One, of course, what we discussed is asset diversification. Let's say you have 10 crores. You already have invested something in real estate, some in equity, some in debt. You have a house, maybe some in gold. And you can say, all right, I can invest 10% return in startups. Why? Because these are higher return bets. Maybe I'll get 25%, something I won't get from stock market. So it's a great way to diversify your portfolio, earn high returns. Also, for a lot of angels, it's a way to monetize the experience. Let's say you have worked in SaaS businesses for 20 years or 15 years. Now, you know what's a good SaaS business looks like what are the good founder traits. This is something you can't do in stock market, right? So here you have an unfair advantage especially for people who have worked in startups before or have worked in industries before. A lot of people also invest because it's a great way to meet smart founders, smart people. It's a lot of fun. But the biggest risk of investing in startup is there are very high failure rates. So you should always diversify. Never invest in 3, 4, 5 startups and forget about it. Most likely you lose money. If you want to invest in startups, go with a plan and say, hey, let's say my net worth is 10 crores or 5 crores. I only want to invest 50 lakhs in startups. I'll spread that bet over 10 companies or 15 companies. And then go with a longer term horizon. Also remember that startup equity is very illiquid. You can't sell it when you need the money. It's not like an FD or a stock market. You have to wait for an exit opportunity. And we'll talk about how do angels make money. So even though you invested in a company and the valuation went up by 10x, it's just paper money. If you needed to buy a house, you won't have that liquidity. You can't sell it when you want. Hence, always invest a tiny part of your capital into startups because you don't know. Maybe you found a good deal, you want to buy a house or want to fund your kids' education, and then don't rely on startup equity for that. Startup equity is a way to create long-term wealth, but not something that you can liquidate it at a moment's notice. You can't sell it when you want. This was a question. So usually how angels and early stage funds make money? The easiest way is, let's say you invest in a seed stage or a pre-seed stage as an angel investor. Now, most likely you won't wait for an IPO. What will happen is, if the startup does well, they raise their Series B or Series C round, a large VC will come in and they'll buy your stake at a higher valuation. These are called secondary stakes. All early stage investors, angels, early stage investors buy out angels, late stage investors buy out early stage VCs. And then late stage investors, they go to the IPO and then they make money. The second way is you get acquired. That is, the company did well and some other company acquired it and then you made money. And always remember that when you do like a secondary exit, there's always some discount. If the market value of the share is, if the company raised capital at $50 million valuation, the incoming investor won't give you that valuation for your equity. They'll give you 40 million or 35 million. There's always some discount. So always keep that discount in mind. And this discount again varies from time to time. Sometimes it's 20%, sometimes it's 30%. It depends upon how easy capital is available. Again, a lot of angel investors have very unrealistic expectations. They say, hey, I want to make 10x return or a 20x return, which is fine at an individual startup level. But you can't have 20x return at a portfolio level in 3-4 years or 5 years. This is a study they did in the US where they said, they asked angels, what was your expectation at a portfolio level? And then average answer came in was 9x. Whereas the reality was the people, and then these are different studies they did, they realized that most angels make around 3x, 4x return in 3-4 years. And this is again US study where returns are slightly lower because stock market also doesn't give you such high return. In India, they'll be slightly high. So my rule of thumb is if you can make 4x, 5x in 5 years, 6 years at a portfolio level, that's a great bet you have. Don't think that if I invest 1 crore in startup, I'll make 10 crores in 5 years. That's not going to happen. Like these are not lottery tickets that either you make like 100x or you lose the money. Think of them as an asset class. Any questions on this? I know it's a very long session. So, see, again, I have a lot of content to talk about. We don't have enough time. Maybe we can take 2-3 final questions. Or if not, maybe I can cover one more slide. What would you prefer? Yes, sir.
Okay. I'm catering the non-profits currently. Even the non-profit segment is huge. It's like 1.2 trillion. But that's a non-profit aspect of it. Will basically an angel investor interested in that, investing in a startup which caters to the non-profits?
No, but your startup is for profit, right?
I am It's a private limited company.
You are not a non-profit company, right?
Yes.
No. So then you will find a lot of investors interested because there is a category of investors who are called impact investors.
Okay.
So they also want to make money. It's not that they are just giving away money, but the objective of their fund is to invest in companies that create a positive impact on the society. So it could be like a climate tech company. I just met a founder, I think, and they said they are creating forestation software for NGOs. Now the end users are NGOs, right? So, but these guys are making money because of their technology. So you'll find a lot of investors interested in such companies. It all depends upon what you're building, like we said, like what you're building. Are you the right guy to build it? How big this could be? As long as you are a for-profit company, investors would be interested.
Yeah, we are.
Yes, ma'am.
I don't know if this was covered in the later slides which you proposed to say, but lots of talking happened around numbers and what kind of revenues that VCs will target when they are investing. But when VCs are investing in an angel round or seed round, does VCs also pay attention to the kind of rights that they should have in the startup or maybe a mid-sized company to have that comfort cushion that, to some extent our investment will be protected? I understand there is no sure shot thing, but is this one of the criterions that VCs consider in terms of
Very
the
good
sector?
question. So it's not an investment criterion. So when you evaluate a company, you look at businesses that can grow big, where you think they can become a big business. And then these are 5-6 standard rights that all investors use. Any term sheet you sign will have these standard rights. So this is not an investment evaluation criterion, but any investment, all investments would come with these rights to protect their interest. And these are broadly standard rights. So whenever you're raising any capital, even a small amount, it's a great idea to go on the internet, find out whether the right investor is giving you is a standard right or is it a non-standard right. If you're raising a slightly larger round, good idea to have a lawyer, a small lawyer or some CA who has worked with startups before. They can tell you, hey, this term sheet is founder friendly, non-founder friendly.
Yeah, actually myself is a transaction lawyer, and the main question, and I specialize in the startup area.
Wow.
So the main question that I face from the founders all the time, oh my God, he is asking a observer on the board or a board seat. Oh, so many AVRs, why should I give this? This is my company, I have built it. So, as a transaction lawyer, to facilitate the transaction, it becomes a really
I'll
tough.
tell you what you should tell them.
Yeah.
So that all founders will be convinced. And this is very critical for all of you founders. When you build a company, it's your company. The moment you raise capital, it ceases being your company. It's your investor's company. Don't think of them as someone like you're just taking their money and it stays your company. No, that's a very wrong mindset. Now you're part owner of the company. The investor also owns the company. If you're not comfortable giving them rights for whatever reason, you think, hey, this is a bad investor, he'll take away my company, don't take their capital. Only take the capital from people you are comfortable with, whom you want to work in the long term, and think of your investors as your partners. Why? Because as investors and as founders, our goals are aligned. If the company doesn't become big, everyone loses, right? And as an investor, I know I'm not smart enough to build a company. If I was smart enough, I would be building a company myself.
Correct.
The only reason I'm backing founder is because I think this founder is smart enough to build a really large company. Now, as a founder, you know like you're smart, of course. All founders are smart. That's why they're starting up companies. But also know that, hey, this investor is backing me with his capital. He deserves some respect.
Correct.
He deserves some right. It's not your company anymore. Like both of you jointly own the company. And this is what I tell all founders that, hey, you're not fine with this right, you're free to walk away from the deal. Don't take my money. And this is what you should tell to the founders.
Yeah, so it is important that founders be sensitized of the fact that this is not one-way traffic. Look, you are asking the person to pump in money in your company and not give anything in return in terms of governance and administration.
Very important point. And as a transaction lawyer, that is your job to explain them. And also tell them that, hey, these rights are standard. these are non-standard rights. So sometimes investors ask for something which is very founder unfriendly. And then you can advise them that, hey, these are not in your interest. All good investors would ask for these standard rights.
And it does have some role in deciding or not deciding the investment.
Yes, yes. So it's not an evaluation criterion, but it's a yes-no criterion. That I really like a company. I'm not going to say I'm going to invest because of these rights. But if the founder is not comfortable with these rights, I won't invest.
Thank you so much.
You're welcome. I think we are done here. Everyone's yawning. Or any more question, or should we wrap up? Yeah, I think we're already 5 minutes past 6. Thank you for all your time. I know I spoke a lot and took a lot of your time. Thanks for your patience.
This answers that question. The audience was so impressed, and that was such an awesome session. Thank you so much for such an informative and empowering session. And I'm confident many here will take their first steps into the world of angel investing with a renewed confidence. So I would request Ms. Divya Nair, the founder of Nomos, to give us token of our gratitude and appreciation to Mr. Pushkar.